Yesterday's move in NIFTY was not just a fall, it was a controlled auction lower with clear acceptance. And if you understand the signals we discussed earlier, this move was actually very readable. Welcome back to Mind Monastery. If you find these videos helpful, please push that like button and subscribe to this channel. Share this channel to every trader you know so that conscious trading evolves and everyone gets benefited with collective consciousness. Most importantly, share your comments and views so that I can create more informative content that can help you with strategic and objective trading. So in the last few videos, we built a structured framework and we discovered how to detect the move and how to execute the move. Yesterday's session, that is 30th March 2026, gave us a real market example of the detection and execution frameworks working together. I hope you could have made some profits out of this. Coming into yesterday's market, the market was already weak. Value had shifted lower from previous sessions and price was trading below the prior value zones. So the bias in the starting was very clear. The sellers were already in control. Now let's break down yesterday's movement step by step. The market showed an early balance in the first phase. The market opened approximately 190 points gap down and rotated below the previous session's lower value zone. An initial pullback was seen which did not hold and there was some sideways movement afterwards. But there was definitely no strong bullish initiative and that gave us the idea that there is lack of buying and hence the bias was almost confirmed. Later, in the second phase, we saw that the price started moving below the developing value area, which was around 22,700 to 22,550, and then it did not come back strongly. This again gave us the clue that the leaving value trigger is on and it is indicating towards the downside. Then in the next phase, we saw an acceptance below value, which is the most important finding. The price stayed below value, it built structure there and it continued forming lower highs. This confirmed that it was a real move. In the phase 4, we saw a controlled downtrend. Market moved lower gradually and not impulsively. Some small pullbacks were there and that also helped us to understand that the downward bias is existing and there was continuous pressure. So we understood that institutional selling is happening and whatever selling is happening is not a panic selling. Now this is something most traders misunderstand. Before every move, the market rotates, it tests certain levels and then moves again. When price comes into value, it is not a reversal immediately. It is a test of acceptance. We have seen this multiple times yesterday. So please remember that entering value is just a test and staying in the value is acceptance. So in yesterday's market, we saw that the price opened below value. Then there was acceptance of value and then it got rejected again. So the result was continuation lower. Now in the last two videos, we have understood the detection and execution frameworks. Today we'll look into the trade management aspect and finally we will look into tomorrow's key levels. So the trade management framework. Millions of transactions fire across the market every second. Before it is organized into a structural framework, raw market data is nothing but high-speed, chaotic motion. Getting into a trade is merely a tactical execution. The actual war of attrition happens after you enter the market. Managing the trade is your true strategy. Most intermediate traders fail because they treat a prior value area on their charts as a rigid, impenetrable wall, assuming any contact with that boundary dictates an immediate exit. This is a 5-minute candlestick chart showing a clear downtrend. Watch what happens when a single aggressive bullish pullback pierces this shaded zone, marking the previous value. For the amateur, that flashing intersection triggers immediate panic. By reacting blindly to a price intersection, they take a completely standard market mechanic, a structural liquidity test, and manually guarantee themselves a realized loss. When the market violently re-enters a previous value node, it is rarely executing a sudden structural reversal. It is almost always hunting for resting liquidity. The amateur panics at this tick. The professional ignores the noise and interprets the underlying auction. To survive mid-trade volatility, you must wait for acceptance. Acceptance is the only true indicator that a structural market shift has occurred. Acceptance requires strict criteria. It's a time-based process that demands overlapping price action over several intervals. It is never a single isolated event. To survive aggressive pullbacks, you must deploy a specific hierarchical framework. This framework is designed to differentiate a temporary liquidity test from true structural acceptance. Mastering this distinction replaces emotional fear-based exits with objective phase-based control over the entire lifespan of your trade. We analyze mid-trade friction using a three-pillar hierarchical framework: the structural control, the value-based control, and the micro-auction behavior. The layer 1 is structural control. This serves as the unbreakable anchor of your position. In a short position, structure remains intact as long as lower highs continues to form and market acceptance remains entirely below the prior value. In layer 2, which is the value-based control, established value acts as the market's psychological comfort zone. As long as price action remains exiled from this previous comfort zone, the directional seller maintains total dominance over the auction. The layer 3 is the micro-control. This is the tightest filter utilized to gauge the immediate health of the directional move. Here we read internal candle overlap, rotational speed, and delta divergence. These specific metrics measures exactly how aggressive a pullback really is. We have not yet talked much about delta divergence, which we'll cover in coming videos. Filtering a pullback through all three of these layers ensures you will never be shaken out by a single isolated anomaly on the chart. A strong, sustainable trend explicitly requires pullbacks to continue its momentum. These moves are driven mechanically by institutional profit booking, the creation of fresh liquidity, and the re-entry of late participants. This chart shows the visual signature of a mere test against a value area. The single green candle spikes deeply into previous value, but immediately forms a long upper wick and closes completely outside the boundary. That quick entry and immediate rejection means minimal time was spent at the new price, confirming a liquidity hunt. Now compare that to actual acceptance. Here, three consecutive candlesticks form side by side, bodies overlapping entirely within the shaded value zone. During these pullbacks, human psychology works against you. The brain naturally misinterprets healthy market mechanics as an immediate threat to your floating profit, because a strong trend must refuel through pullbacks. The exact market action that triggers retail fear is the very engine of the trade's continuation. On a fast-moving 5-minute intraday chart, we execute a specific mechanical protocol to validate acceptance. We use the 3-candle rule. It serves as a strict chronological filter to prove that buyers and sellers have agreed on a new price. The protocol begins at candle 1, the initial aggressive boundary pierce. Ignore it, wait. Candle 2 is the observation phase, monitoring for sustained closes without rejection wicks. Candle 3 is the final decision matrix. Overlapping closes inside the zone confirm acceptance, mandating immediate exit. Delaying your reaction by just 15 minutes filters out high-frequency noise and reveals the underlying intent of the auction. For ultimate confirmation, we track volume distribution by monitoring the migration of the point of control. This split view chart displays a valid hold. Price enters the value area, but the highest volume node, the POC, remains below current price. Sellers maintain control. But watch the exit scenario. If the POC physically migrates upward to join the price, buyers have seized control. This volumetric migration acts as the definitive mathematical proof of a completed structural shift. Price action alone can temporarily lie to force a shakeout. The distribution of volume over time provides the undeniable reality of who owns the auction. The final physical manifestation of trade management is the placement and evolution of your stop loss. Relying on a static, immovable stop loss guarantees failure when interacting with a constantly shifting dynamic auction. Stop evolution happens in stages. After anchoring the initial stop at the failed auction level, you shift it downward strictly after a newly confirmed lower high is established. As the trend enters the exhaustion phase, you transition to trailing the stop tightly using microstructure boundaries. Your stop loss must exclusively evolve in lockstep with the structural reality of the market, never in response to your internal fear of losing floating profit. During moments of extreme mid-trade friction, you must rely on an overarching mental matrix. Ask yourself 3 binary questions. Is the macro structure intact? Is the value positioning favorable? Is the current price action a test rather than acceptance? If all 3 questions yield a positive alignment, you hold the trade, regardless of the temporary psychological discomfort. Abandoning the trade is only permitted when one of these objectives, structural pillars, mathematically break. Entering a value area is merely the signal to observe. Staying in a value area is the signal to act. The market will inevitably attempt to shake you out before moving in your favor. Clarity comes from structure, but realized profit only comes from patience. Hopefully this part of the video has added some value to your trading. Now let's quickly jump into the key levels for the next session. The current value, that is the POC, is at 22,480 level. This definitely can act as a very decisive zone. Depending on the market opening, this zone may work as a resistance or a support. But however, please remember that this current value is a very important decisive zone. The most important resistance is 22,550 to 22,600 zone. If the price reclaims this zone, there is a possibility of short covering. The most important support zone is the 22,300 to 22,330 zone, which is the current reaction zone. Now, if it breaks down below this support level, that is below 22,300 level, a further downside continuation is possible. If that happens, 22,172 and 22,115 can act as further supports. For a bearish scenario, acceptance below 22,450 is needed, and then there can be a continuation of lower value. And for a bullish scenario to build up, reclaim and acceptance above 22,550 becomes necessary. Possible rotation back to value within 22,550 to 22,600 region can also happen if the market starts stagnating within this zone. If you are understanding this structure, you will realize that the market is not random. It is an auction process, and your job is not to predict, but to understand where the market is getting accepted. Thank you for watching, and wish you consistent profitability with strategic trading. Happy trading.